America, the land of opportunity, has attracted millions of immigrants from all over the world. People escaping religious and political persecution and seeking economic freedom have come from all over the world to live in the United States of America. New York City was, and still is, a gateway for countless immigrants coming to America. Their story is reflected in the lives of immigrants throughout the country. I am one of them. In this documentary about the Federal Reserve's first 100 years of existence, we will examine how the Fed, the nation's central bank, has affected all Americans, not just immigrants who came to live the American dream. My family's journey begins in 1949, when my parents, my older brother and I moved into that first-floor apartment on East 8th Street, weeks after we arrived in America from war-torn Europe. The one-bedroom apartment did not have a shower, only a tub in the kitchen, and we shared a bathroom with our neighbors in the hallway. My father was making $1 an hour in a nearby pencil factory which supported our family. In 1949, you could buy a new car for about $1,700, gasoline 26 cents a gallon, bread 14 cents a loaf, milk 84 cents a gallon, a dozen eggs 25 cents, a postage stamp was 3 cents, a hot dog was a nickel, and a New York City subway ride was only a dime. The average annual salary was $3,600. Minimum wage was only 40 cents per hour, and a decent house was between $5,000 and $10,000. And when it was time to get some sweets, we walked over to Economy Candy on Rivington Street. Do you still have penny candy here, Mitch, at the store?
Penny candy doesn't exist anymore, unfortunately.
In 1953, a few months before my younger brother was born, my parents took virtually all their savings, $500, and bought a Dumont black and white television with an FM radio in it for $350 and an Electrolux vacuum cleaner for $150. That $500 in 1953 is the equivalent of $4,400 today. In other words, it takes $4,400 today to buy what cost $500 60 years ago. That's the bad news on the price front. The good news is that today, $4,400 can buy a laptop computer, a big screen HD color TV, a cell phone, an iPad, and other high-tech items, and we would still have money left over. In other words, our dollars can go a lot further than they did 60 years ago to purchase many high-tech goods. After my parents made their first major consumer purchases, we moved to the Bronx, here on Harrison Avenue, where the rent was $73 for a 4-room, 2-bedroom apartment with its own shower. While we were living here, my father got a job as a sheet metal worker in the East Bronx. He worked 40 hours a week at $3 an hour. His take-home pay was $108.52, slightly less than his $120 a week gross income. In 1968, I got married. My wife and I moved to West 238th Street in the Bronx. Our rent was $130 a month. By the time we moved in 1977, our rent was $200 a month. That year, we realized the first piece of the American dream. Here we are in Middlesex County, New Jersey. In 1977, my wife and I bought our first townhouse for $45,000. In 1981, we sold it for $72,000. Today, townhouses are selling in the development for about $200,000. In 1982, we bought this house in Bergen County for $90,000. After adding a family room and finishing the basement, we sold it for 7 times what we paid for it in 2007. We clearly benefited from the housing bubble. What does this all have to do with the history of the Federal Reserve's first 100 years? Plenty, because since the Fed was created, the US dollar has lost 95% of its purchasing power, even though one of its original mandates was to preserve our money's buying power. Today, gasoline averages about $3.60 a gallon, bread $1.40 a loaf, milk $3.43 a gallon, eggs $1.92 a dozen. The average price of a new house is $190,000, and an average price of a new car is around $30,000. A hot dog has gone to $3.15, while the average annual salary is around $48,000 per year. The minimum wage is $7.25, a postage stamp has gone to 46 cents, and the New York subway fare has gone to $2.50. In other words, prices of most things we buy and the services we need have increased virtually year after year for decades. From food to utilities to college tuition to health care. the prices of all these essential services have gone up substantially. Why? During this documentary, we will also discuss why our economy has been on a roller coaster. Periods of prosperity followed by short and sometimes not so short slumps. Are there any lessons we can learn to prevent the cycle of boom and bust from repeating? Or is the boom and bust cycle an unavoidable feature of capitalism? To help us sort out the Federal Reserve's impact on our economy, we spoke to several experts in economics, finance, and accounting. The views expressed by our experts do not reflect the organizations and institutions they are affiliated with. We invited current and former Federal Reserve officials to give their perspectives on the Federal Reserve's first 100 years, but unfortunately, none of them accepted our invitation. Before the Federal Reserve was created in 1913, there were several attempts to create an institution like the Fed in the 19th century.
What did the U.S. do when it didn't have a central bank? I think the first thing to say is that the banking system grew up very rapidly in the United States. And so, there were hardly any banks at all before 1790. Then by the 1830s, there are like 600-700 banks that grew up in that period. These were banks chartered by state governments. Corporations, banking corporations.
There was a precursor to the Fed. It was called the Bank of the United States, and it actually was in the 18th century. It was started in 1781, and it was given a 20-year charter, and it created so much economic upheaval and political corruption that Congress did not renew its 20-year charter.
Americans, right from the beginning of the country, have had suspicions of financial power, especially concentrated financial power. And
it was the original idea of Alexander Hamilton, and Hamilton basically wanted a bank run by politicians.
Thomas Jefferson and John Adams used to write each other letters saying how the country was going to hell in a handbasket because of these newfangled things called banks.
And it was as light a touch of a central bank as you could possibly imagine. It was mostly owned by private shareholders. The government owned some stock early on, but then sold it. And it was basically there to act as the fiscal agent of the federal government and to act as a lender of last resort.
Then we had a second Bank of the United States, even larger than the first bank. That was from 1816, and again chartered for 20 years. Congress did recharter it in 1832, but President Andrew Jackson vetoed the recharter. So I would say that throughout American history, there is a suspicion of finance, high finance.
The farmers always bore a disproportionate burden of inflation from the banks because they were always big borrowers. They were always borrowing money, and if interest rates are driven up, they have to borrow at higher rates and so forth. And so, philosophically, you had the libertarian wing of the founding generation at the beginning, headed by Jefferson, being opposed to this. And then just as from a practical reason, a lot of yeoman farmers and small business people and merchants just didn't trust these banks run by politicians. One famous episode of this was when the Bank of the United States set up 2 branches in the state of Ohio, which is, then this was in the 1820s. And it still is a highly agricultural state, and you can imagine how it was then. And it created quite a furor and a protest, so much so that the state legislature in Ohio imposed a $50,000 a year tax on each branch of the bank in the 1820s. And the Bank of the United States refused to pay, so the state of Ohio sent armed marshals into the bank, and who went right into the vault and took $100,000 out of the vault of the Bank of the United States.
We then fought the War of 1812, and the federal government had some problems handling the war financially, and so there was a movement to form another bank.
By the time you get to the 1830s, President Andrew Jackson had had enough, and he took on the Bank of the United States because it was corrupt. It was funding his political opponents. But then after that, it was called the free banking era, where there were competing currencies that were issued by different states.
Then we fought a civil war in the 1860s, and we did not form another central bank to help finance that war.
During the Civil War, Abraham Lincoln's government decided that we needed to have a system of national banks, and so the legislation of the Civil War era created the national banking system.
And and this was always the reason. It was the reason Hamilton wanted a national bank, and it's the reason Lincoln wanted a national bank. They saw it as a vehicle for permanent political power because they could have a bank that could print money. We did go back on the gold standard by the late 1870s because there was a long history of understanding of sound money backed by gold and silver.
I think we have a fractional reserve banking system, and this kind of leads into panics because the banks never have enough in the way of reserves to pay off all the depositors. Maybe there's $1 in deposit in reserves for every $8 or $9 or $10 of deposits. Now that doesn't matter in most periods of time because commerce, the nature is we go out and spend our money and somebody else has it, they take it to the bank and deposit it back in the bank. So banks don't need to have anything like 100% reserves. They can get by in normal times with a fractional reserve. But then you run into periods when people suspect the banks or they suspect something bad is going to happen and they run on the banks and try to pull out all their deposits, and the bank never has enough to do that. So, and that kind of contributes to the bank run because everybody knows the bank doesn't have enough money to pay off everybody, so I better be in line first to take the money out.
Originally, the Fed was created in response to the Panic of 1907, where the banks and other institutions got into trouble because of liquidity problems, where they needed short-term loans, and J.P. Morgan had to come in and rescue them. So it was thought that this really wasn't a good situation, that the whole community is dependent on J.P. Morgan. So there was a movement for a central bank of the United States in order to provide what they called an elastic currency. And if you go and look at the actual Federal Reserve Act, it mentions an elastic currency as the primary purpose for the creation of the Fed.
Well, I think the Federal Reserve did, in fact, smooth out the business cycles a little bit, or it certainly smoothed out. There's research showing that the Federal Reserve evened out the seasonal fluctuations in interest rates when it first came in, and that should have helped stabilize the economy a little bit.
Well, the fundamental problem with the way banking existed then and to this day is that it has a maturity mismatch, which means they basically borrow short and lend long. And so that works well when things are going well, but then when a crisis sets in, the banks basically get caught with their pants down. And so rather than try to reform their practices and be more secure, they thought that what we need is to have this lender of last resort to come in and be able to just always bail us out short term when we get in trouble with our practices.
Although the United States experienced several financial panics in the 19th century, the country did not get a permanent central bank until President Woodrow Wilson signed the Federal Reserve Act on December 23, 1913. The Panic of 1907 provided a major impetus for pro-central bank forces to clamor for an American central bank. The agitation for our central bank culminated in a secret meeting that occurred on Jekyll Island off the coast of Georgia in 1910 at a resort owned by J.P. Morgan. Only 6 people attended this super-secret week-long meeting, and they reflected the interests of the major bankers in the United States. 3 years after this super-secret meeting, America's powerful Wall Street bankers realized their dream, a central bank that would now have enormous power to create money, which was then used by bankers to expand credit in the economy. This is called easy money, or now quantitative easing. In a nutshell, the Federal Reserve has an unlimited checking account and can buy government bonds and other assets from bankers and other institutions. This is known as open market operations. When the new money is deposited in banks, more loans can be made at lower interest rates to everyone who is seeking to borrow because the supply of credit has now increased. The Federal Reserve's easy money policies are supposed to stimulate the economy without any harmful effects. But the evidence is quite the opposite. The new money from the Fed tends to raise the price of stocks, real estate, commodities, prices in general, and of course, wages and salaries. Although wages and salaries do increase for most Americans during the boom, prices tend to rise faster than their wages. Thus, the average working American usually sees his purchasing power reduced during the cycle of boom and bust. As prices rise and the economy overheats, the Federal Reserve raises interest rates to prevent prices from getting out of hand. The economy then enters the bust phase of the cycle, which becomes inevitable because the Fed stimulated the economy in the first place. The Federal Reserve began to operate in 1914, and one of its goals was to prevent a severe or prolonged downturn in the economy.
Well, I think the Federal Reserve was sort of unlucky that it came on stream in the summer and fall of 1914, just when World War I broke out. And so one might say the Federal Reserve was still a baby, but it was enlisted in the Army in World War I. Now, the war for the United States didn't start until 1917. The Fed by that time was almost 3 years old. But it still, the important point was to win the war, and the government had to borrow a lot of money during the war. The Treasury issued a lot of, first they were called Liberty bonds, and after the war they were called Victory bonds.
The so-called Depression of 1920 and 21 was sort of deliberately engineered by the Federal Reserve in the sense that right at the end of the World War I, price inflation was exceeding 20% annually, and of course the government had run up a huge debt. And so the federal government slashed spending by over 65% in a single year, and the Federal Reserve, to try to tamp down on price inflation, jacked up interest rates to record highs at that point. And so there was a short-term sharp depression, unemployment went up to 12%. But because it was a relatively free market era and the administrations didn't do anything, didn't try to fix the economy, it fixed itself pretty quickly. By 1923, we had a full-blown recovery and it led to what we now call the Roaring '20s.
Well, there's no doubt that the 1920s were a sort of a very heady time, I would say, in U.S. history. We did come out of World War I being the financial leader of the world. Before World War I, Britain and the London capital market was the top place in the world. It's where you went to borrow money if you were some other country. After World War I, New York became the financial center of the world, and the United States became the number one country economically, and probably been number one economically for quite a while, but it was number one financially. Plus, then you get all these new technologies, radio and electricity in general is coming in. My parents were old enough where they still called the electric refrigerator an icebox because they remembered that when they were kids, the Iceman came and delivered a block of ice. And so when the electric refrigerator came along, my parents still referred to it as the icebox. There were all kinds of things like that: washing machines, dryers, radio, and the movies were moved. They were a big business in the 20s, and by the end of the 20s, they were moving towards sound. Not silent movies, but sound movies. What do you have? Airplanes. Just all kinds of new technologies were coming in. Productivity was fairly high. In fact, the stability and all the heady new technologies actually made people optimistic, and then perhaps overly optimistic, driving up stock prices. And there were some economists that thought, well, it's a new era. Irving Fisher is the economist who said just before the market crash, stocks have reached a permanently high plateau. He was actually one of the greatest American economists, but he lost a lot of his reputation for making that wrong prediction. So I think if a great economist can make a mistake like that, other people could say, we had no reason to believe anything was wrong with the economy. But in fact, the economy slowed at the end of the 20s, the stock market crashed, and then we had the Great Depression.
Although President Hoover's interventionist policies did not end the Great Depression, many economists and historians claim that Herbert Hoover was a do-nothing president, when all the evidence shows that the Congress passed legislation that interfered with the free market under his administration. In fact, in his acceptance speech for the presidential nomination in 1932, President Hoover said, quote, "We might have done nothing. That would have been utter ruin. Instead, we met the situation with proposals to private business at the Congress of the most gigantic program of economic defense and counterattack ever involved in the history of the Republic. We put it into action." At the end of the presidential campaign, President Hoover summarized the measures he had taken to combat the Depression: higher tariffs, more expansion of credit by the Federal Reserve, injecting capital into savings banks, more agricultural loans to farmers, spreading of work to prevent unemployment, and badgering employers to maintain wage rates in the midst of falling prices. By any objective standard, Herbert Hoover was a big government Republican who believed that the use of the federal government's enormous power would end the Depression.
Well, as far as explanations of the Great Depression of the 1930s go, I've actually come to, accept a good part of what Milton Friedman and Anna Schwartz said, that the Depression need not have been as bad as it was, and one of the reasons it got to be as bad as it did was because of the collapse of the money supply, which dragged down the price level, which turned good bank loans into bad ones. I mean, the farmer who borrowed money thinking he's going to sell his wheat for $1 a bushel, if it turns out he only gets 50 cents a bushel for it, it's harder for him to repay his bank loan.
It's funny, a lot of people describe FDR as saying he got us out of the Great Depression. And that's true in the literal sense of he was in office when the Depression was still there, and then the Depression arguably ended by the time he died when he was still in office. And so that's the sense in which you could say vacuously FDR ended the Depression. But under any reasonable benchmark of comparing the length of previous financial crises or depressions with a small d in U.S. history, clearly the Great Depression was the longest and most agonizing one on record.
I think once the Depression really got going, and I date that more from late 1930 rather than the stock market crash in 1929, you had these waves of bank failures that Friedman and Schwartz pointed to. The bank failures, we didn't have deposit insurance, that destroyed money. People just lost their jobs, couldn't repay their loans, the prices were falling, they couldn't repay their loans. We had all that inflation in World War I, but because the U.S. was gaining so much gold, we never left the gold standard. Now, the gold standard is a system that's supposed to deliver long-run price stability. If you think about it, if the price level doubled in World War I, but the dollar was still, defined as 1/20th of an ounce of gold, roughly speaking, some friends of mine have actually said, the deflation of the Great Depression was really necessary to restore the pre-World War I price level, and that's the way the gold standard is supposed to work. And that made me think, I'd always thought the Depression was really a tragedy, but this latest reasoning that maybe the deflation of the 30s, if you were going to hold the dollar at 1/20th of an ounce of gold, you needed to deflate the price level to get back to where you were when you had a gold standard world, so that's an interesting issue that I think we haven't really resolved yet.
I would argue that FDR's policies during the Great Depression were a fantastic failure in the sense that he delivered the longest, most agonizing recovery in U.S. history. Everything in terms of economic theory that they did would be designed to prolong the Depression, propping up wage rates at a time when consumer prices were falling, so that makes labor more expensive. So of course employers are going to be reluctant to hire, instituting all sorts of price-fixing schemes, cartelization schemes, all sorts of interventions in the private economy, making property rights less secure, all these things. And plus, he was openly hostile to business in his campaign rhetoric.
The Fed contributed to the speculation of the late 1920s, and then, of course, which that speculation may have led to some sort of downturn, and then the Fed didn't do much to counteract that. But I don't think the Fed was actually creating money in the late 1920s to make the stock market go up. In fact, most of the evidence is the Fed was worried about the speculation in the stock market. But what happened was the United States tried to help Britain get back on the gold standard. And Britain, went off the gold standard in World War I and was trying very hard to get back on it because people thought the gold standard was the right way to do things. And they wanted to restore their pound to its old pre-war parity, which meant that you took $4.86 to buy 1 British pound. The British had to deflate their economy to do this, and the Federal Reserve tried to make it easier for Britain to hang on to its gold by keeping low interest rate policy in the U.S. And I think that may have contributed to some of the speculation in the late 1920s.
At Bretton Woods, New Hampshire, delegates from 44 allied and associate countries arrived for the opening of the United Nations Monetary and Financial Conference. Invited by President Roosevelt to the first major world financial meeting since the London Conference of 1933, they will work in the seclusion of this White Mountains resort.
As World War II was drawing to a close, an international conference was held in Bretton Woods, New Hampshire in 1944 to create a framework for a stable post-war global economy. At the heart of the Bretton Woods system, the U.S. dollar, which was now defined as 1/35th of an ounce of gold and only redeemable by other central banks and foreign governments, would be the key global currency for the international economy. During the post-war years, the Federal Reserve inflated the United States money supply, and billions of these dollars were used to buy foreign goods from Western Europe and Japan. These dollars eventually came back to be redeemed for gold by foreign governments and central banks.
One of the spoils of World War II was that the U.S. was able to turn its paper dollars into the equivalent of gold for the free world, and that was the Bretton Woods system.
To understand the Bretton Woods system, you first need to understand the classical gold standard. So under the classical gold standard, all the major governments tied their own currencies to gold at a fixed weight. So the British pound was exchanged for gold at a fixed weight, the US dollar was $20.67 for 1 ounce of gold, and so forth. In 1933, FDR ended the U.S. participation in that system, and so now private citizens couldn't turn in their U.S. dollars for gold. But after World War II, there was still a desire to have some sort of gold standard around the world, and what they did is they had the U.S. dollar now be the world's reserve currency, as it were, but the U.S. pledged to other central banks, we'll let you redeem your dollars for gold. It happened to be at the rate of $35 an ounce at this point. When we're trying to evaluate whether the Bretton Woods system was good or bad, it's useful to pick a benchmark. So compared to having no tie to gold and having all the governments of the world just have pure fiat currencies, I would say the Bretton Woods system was good in the sense that it at least imposed some discipline, that the U.S. government still was on the hook for redeeming dollars for gold at the rate of $35 an ounce. So it restrained the inflation that the Federal Reserve could engage in.
At first, not only is there there have been a shortage of gold, there was a shortage of dollars. If you look at primary sources from the period, they talk about the dollar shortage. Britain, France, the rest of the developed economies of the world can't get enough dollars, even though we're acting like a fractional reserve bank vis-a-vis the rest of the free world. That changes over time as Europe rebuilds its factories and its infrastructure, and we get to the point where countries like France can actually start to take dollars that they no longer need and return them to the U.S. and ask for gold.
By the late 1960s and early 1970s, the United States was rapidly losing its gold stock. On August 15, 1971, President Nixon imposed a wage price freeze to check inflation. In addition, the president also brought the post-war Bretton Woods system to a crashing end. President Nixon effectively declared the United States government bankrupt because the federal government could no longer redeem all the dollars held overseas for gold at $35 per ounce. Now the U.S. dollar was nothing more than a fiat currency. Since the end of the Bretton Woods system in 1971, which was the last link between the dollar and gold, the dollar's purchasing power has declined by 80%. In other words, it takes more and more dollars to buy the same basket of goods that could have been bought in 1971. That's the bad news. However, because of the technological revolution, prices of television and other goods that were introduced in the 1980s and 90s, such as computers and cell phones, have declined dramatically. Another example of how free markets tend to drive down prices of all consumer goods.
1971. So now you have a situation where in the 70s, this is when you have a situation where, when they say the chickens are coming home to roost? Well, they did it big time during the 1970s. It was at this point when we started to have large problems with debts, and the inflation actually ended up happening not so much in the stock market, and it was very, the real pronounced effect was actually the money flowing into goods and services during the 1960s. And to a great extent, it's because the dollar had just a terrible year, because when you're printing too much of it, sooner or later, you're going to have what? Each individual unit of that thing that you're printing up, in this case, the US dollar, it's going to shrink in value. So you had a contraction of the real buying power of the dollar happening from 1971 onward.
In the 1970s are often described as a period at the Federal Reserve of stop-go policies. There were two big problems at the time, unemployment and inflation. Sometimes the Fed would look at the rising unemployment rate and say, we got to do something about that. And what they did, of course, was ease monetary policy, trying to bring interest rates down. But in fact, the results of that easing were greater inflation, and the markets then raised interest rates instead of reducing them. So then the Federal Reserve, worried about inflation, would tighten money, but then the unemployment rate would go up again. So, you're like fighting, for half a year you're fighting unemployment, then oops, that caused more inflation, so now we better spend half a year fighting inflation.
It's difficult to say what the right thing for a central banker to do is if one doesn't believe in having a central bank in the first place, that these things should be left to the market economy. But given the context, when Paul Volcker came in the late 70s, I do think that his job was to get price inflation under control. And in that sense, he did the right thing, that he slowed the rate of growth in the monetary aggregates that caused interest rates to skyrocket. And it's true that that caused short-term pain, but that's what needed to be done.
When Paul Volcker came in, remember, he had obviously a much different view and a different management style than prior Federal Reserve Chairman. He was intent on breaking the back of inflation, and he was intent on making sure that the dollar was a much stronger unit of value. And so interest rates rose tremendously, during the late 70s into the early 80s. And keep in mind that when interest rates are rising, what is that really? That's, for lack of better ways of phrasing it, like the price of money. When you're borrowing, what's the price of borrowing? Whatever the interest rate you're paying. So when the interest rate rose up tremendously, that actually caused a great amount of strength for the U.S. dollar.
Well, Volcker did help to stop inflation expectations. Inflation's a nasty thing because it's not just the money supply today that determines it. It's also people's expectations about what prices are going to be in the future. And he was able to wring inflation expectations out of the economy. But it came at a very high human cost in terms of unemployment and lost output.
The 1980s, much like the 1920s, is a mixed record because on the one hand, you do have marginal tax rate cuts, of course, associated with Ronald Reagan and the supply side movement, and I would argue those were a good thing that provided legitimate grounds for economic growth. On the other hand, you still had the Federal Reserve inflating the market, pumping up the monetary aggregates, and so on. And what's really funny is that Paul Volcker arguably pumped up the stock market with his policies after curbing inflation, then decided to let it rip once he got it under control. The market zoomed, and then Volcker steps down, hands the keys over to Alan Greenspan, who comes in, and the market has an awful crash in '87, right when he is new on the job. So that's sort of one of the ironies of history, that maybe Volcker saw that coming. I would explain the stock market crash of 1987 in much the way that I would explain the crash of '29, that during the 80s, the Federal Reserve, after curbing inflation early on, decided to open the spigots, pumped up the markets, the stock market was soaring. Volcker, perhaps afraid of the rising price inflation and other things overheating, decided to back off and then handed the keys over to Alan Greenspan, who came in, and then a few months later we saw the market correct, which the euphemism is accurate, I would say, and came down sharply.
In terms of the crash that occurred, we know that the 1980s were a very strong period of time. So the 1987 crash was more of an anomaly more than it was really an auguring in what was happening with the general economy. Because bottom line is, when you look back on that moment, it was an anomaly where you had factors of too much margin borrowing and some other influences that came out of the stock market, which converged in 1987. What happened in 1987 with the stock market was not an extension of all of a sudden the market said, oh my God, the economy is doing horribly. Nothing really bad happened. Keep in mind, part of the move in 1987 also happened from 1986 when the Tax Reform Act occurred, and there was changes in things such as capital gains and some other things which caused a confluence of factors that ended up having the 1987 crash occur. But it was not a crash in the sense of like something that augured in structural changes in the economy. The economy kept on booming, thereafter. The economy kept on doing well right into the 1990s. So that was a one-off stock market event and not something that told us that there was a deeper problem with the U.S. economy.
The dot-com bubble of the 1990s and the housing bubble of the 21st century have been the two most recent examples by the Federal Reserve to try to stimulate the economy under the leadership of Alan Greenspan. As money manager William Fleckenstein writes in his book, Greenspan's Bubbles, quote, "Prices go to the sky and then fall through the floor. Human beings can't help themselves, but the bubbles in U.S. stocks and real estate didn't just happen. These costly distortions were instigated and financed by Alan Greenspan's Federal Reserve."
Well, I think the Federal Reserve maybe kept interest rates too low too long in the late 1990s, just as it did in the 1920s. In the 1920s, our low interest rate policy was designed to help Britain. I think in the late 1990s, the Federal Reserve's low interest policies were because of some financial crises elsewhere in the world. The Asian financial crisis in 1997, the Russia long-term capital financial crisis of 1998. The Federal Reserve at that time was already beginning to act a little bit like the central bank of the whole world. At the very end of the 90s, we were worried about a problem which we called Y2K. We had this fear that all the computers, including the ones that ran the ATMs, were going to just stop working on January 1st in the year 2000. And so the Federal Reserve actually was worried about this. What if you went to your ATM and you couldn't get money out? So in the late 1999, they increased the monetary base a great deal and printed up a lot of currency and put it out there in the banks, so that if the ATMs weren't working, you'd always be able to go in and get money in the bank. And the monetary base took a big spike then. And this was right at the end of 1999. But the last 1,000 points from 4,000 to 5,000 on the NASDAQ actually occurred from November 99 into March 2000. And that's just at the time when the Fed had a huge expansion of the monetary base, worried about Y2K. So I think in that, that kind of tells me that the Fed, of course, wasn't trying to cause the dot-com bubble. It was trying to prevent Y2K from causing us problems.
So during the 1990s, you started seeing where the Federal Reserve, through its member banks, was doing more intervention in the stock market per se. Remember, keep in mind that one of the things that happened in the wake of 1987 was the executive order that created the Working Group on Capital Markets, which basically allowed, for the first time in decades, the government the ability, through the Federal Reserve and the Treasury and some other officials in the government, where they can be able to intervene in the stock market. When you're artificially, rising the price of anything in terms of a bubble, that's when the bubble started forming with the stock market, and the roller coaster ride started going into the 2000, 2001, and onward into 2008. You have those kind of stimulus, so it's going to be just like when you have a pool. If you have the hand pushing through the pool, you're going to cause these artificial waves that occur, the ebbs and flows. So the Federal Reserve in that year, many people rated it highly because they saw the good aspects of it, but they forget that you're going to have to pay for it on the other side. So you had some terrible times for the economy and the stock market in the post-2000.
I would argue that Alan Greenspan's entire tenure was characterized by him turning on the monetary spigots whenever it seemed there was a crisis in the markets. And this, of course, led to the so-called Greenspan put. But you saw that when he first came in, faced with the 87 market crash, he inflated. That allegedly fixed the problem. His policies were in place during the 1990s when we had the dot-com bubble, and economists have gone and looked at his policies and argued that it was because of being overly loose that contributed to that. And then, of course, once the dot-com bubble crashed, Greenspan once again rode to the rescue. They called him the maestro at the time, and he gave us the housing bubble. So you see that Greenspan's playbook was to say, if there seems to be a problem, let's just throw money at it, literally, that we create out of thin air.
I think the Fed policies probably did contribute to the housing bubble. Now, should the Fed have known better? I think they should have known better, because there was a man at the Federal Reserve, Edward Gramlich, who had been a member of the Federal Reserve Board, and his specialty was study mortgage markets and housing markets. And while he was inside the Fed, he had, detected that there were some irregularities. There was too much activity in housing, and that maybe some of these bad loans were being made. And he actually reported this to Alan Greenspan. And Greenspan said, well, you know, I'm not sure the markets will take care of it or something like that, you know, and we don't want to get totally alarmed. So I think the Fed did have reason, should have had reason to detect the housing bubble, and in fact, it ignored some of the evidence that there was a housing bubble.
Well, I think you have to disentangle the two problems. Okay, you have the tech bubble, which I think has some less serious sources of concern, and then you have the housing bubble, which is essentially a major collapse of the financial system. And if you think about what the tech bubble was, it was a lot of overinvestment in the tech center of the stock market. And so, you know, you get an aggregate demand shift outwards, the prices for those stocks go up, and eventually people in the market realize that those tech stocks didn't have the appropriate fundamentals for the prices they were trading at, and so the bottom fell out of the market. And the argument that monetary policy with low interest rates at that time really fed into that, I'm not sure I necessarily buy that as the primary factor. I think Greenspan's view of there's irrational exuberance in that market probably is correct, in the sense that had he raised interest rates to 2 or 3 or 4 or 5%, you know, by significantly raise them, I'm not sure that the bubble would not have happened. I think the housing bubble, though, is much more problematic. Many factors working together caused the housing bubble. The tech bubble, when it burst, really affected some investment banks and individual investors, but it didn't lead to the massive economic slowdown that the housing bubble bursting and eventually leading into the financial crisis was.
One way of gauging just how absurd our policies have become in this financial crisis is the so-called zero interest rate policy that Ben Bernanke has delivered. Interest rates are prices. They're signals that allow people to coordinate their activities, savers and investors. And when the Fed comes in and push interest rates down to zero, that's effectively destroying one major channel of information. It's not the case that the actual interest rate should be 0%. And so Bernanke's not doing us any favors by having that policy in place. All it's doing is making people not willing to save as much. It's causing investors to take on very risky investments because they're having to go out on the yield curve now because traditional returns are so low. Corporate pensions now are all thrown out of whack because now, with interest rates being 0%, their liabilities and assets are mismatched. So there's all sorts of problems that Bernanke's policy is giving us and spawning, I would argue, different bubbles.
So the real question we have to ask is, why is the housing bubble bursting and leading into a financial crisis? Why was that so different than the other bubbles bursting that we've had in the past? And the easy answer is you can start pointing to individual people and you can blame them. I tend to look at a little bit more of a global perspective and say probably the overriding answer to why the housing bubble happened and the financial crisis happened was you had people all acting in their own self-interest, and all their motives or incentive structures were fundamentally flawed.
Unfortunately, a lot of people expect economists to be able to give recommendations that will avoid pain. And so given that we already had the tech bubble, for example, in the late 90s, and then when that burst, it was unavoidable that there was going to be a recession. But if Greenspan had just stood back, let interest rates go to where they should have been, give the right signals to people in the market, there would have been bankruptcies, there would have been liquidations, there would have been transfer of resources. But then after a sharp purge, if you will, and rearrangement, we would have had the grounds for a solid recovery.
Most people living in the United States have not a clue what the Federal Reserve does. They hear the term, it's thrown around, they know Bernanke, but that's where their knowledge begins and ends. What the Fed really has been doing, at least from my perspective as an accounting professor, is they have a reaction to crisis. And things are either going wonderfully, it's a boom, or things collapse, it's a bust. And we've kind of labeled them with these cute terms, bubbles, the dot-com bubble, the housing bubble, the subprime mortgage bubble. We can't be having bubbles in our economy. because it does not allow anyone to make plans, to do their budgets, to make decisions on a long-term investment basis if nobody's really sure of what the future is going to hold. And I really think that's the crisis we're faced with right now.
As the housing bubble burst in 2006 and 2007, and the stock market peaking in late 2007, financial institutions that got caught up in the housing bubble were under severe financial pressure. In addition, the Federal Reserve drove short-term interest rates down to nearly 1%, where they have stayed for the past 5 years in order to stimulate the economy. By purchasing nearly $3 trillion of government bonds and mortgage-backed securities, the Federal Reserve has undertaken one of the great financial experiments in modern times.
I think it's pretty much inevitable that we're going forward, we're going to have recurring business crises, simply because what they do every time a crisis happens is just put in more of what they think is medicine, but I would argue is poison.
Well, the banking system is probably going to become more and more nationalized and controlled and run by the government, because that's the trend of things. When government intervenes in any market and it screws things up, as it inevitably does, its impulse is to give itself more and more power over that market. In the market for money is what we're talking about, because government never ever will admit that it has failed. It can't do that. You lose your job.
The accounting industry recently has had to deal with the problems of the perception that the Fed has been controlling interest rates really unfairly. What is the impact on business? Well, right now what we do see is, with interest rates being at historical lows for extended periods of time, you would think that there would be a great demand for money and the cost of products would be cheaper. Unfortunately, the result of this has been that people cannot qualify many times for credit. The standard to qualify as a result of the subprime mortgage debacle really was astronomically higher than what it had been before, which was in essence non-existent. So now we're trying to adjust the market. When you have consumers, when you have buyers that basically have been trained to purchase on credit, and now that credit is not available, it really does undermine the ability of many aspects of business to continue to grow. Perfect example is the automobile industry. As a direct result of what happened in 2007 and 2008, we had to do a bailout of our automobile industry because consumers were not willing to pay inflated prices for assets if they couldn't buy them on account. If people really had to spend dollar for what they were acquiring, if it wasn't really viewed as monopoly money, then I think the value of a transaction would be reported differently.
It's ironic, when Ben Bernanke began his massive quantitative easing purchases, people at the time were saying, we don't need to worry about runaway price inflation because Bernanke's doing this as monetary policy. It's not as if he's monetizing the debt, which is what happens in backwater countries and causes hyperinflation. Well, the reason that's funny is that in 2011, 77% of the net debt issued by the Treasury ended up on the Fed's balance sheet. And so my question is, at what percentage do we start calling it monetizing the debt? Suppose Bernanke literally absorbs 100% of the government's budget deficit in a given year. Is that going to be counted as monetizing the debt? So the U.S. government right now enjoys tremendous prestige. Investors have confidence. They actually take Bernanke at his word that he's going to watch the indicators and not let price inflation get out of hand. So it's not baked into the cake. They could turn the ship around if they wanted to, but so far they certainly are going down the path of monetizing the debt, which paves the ground for runaway inflation.
I don't have any faith in the political process. I think realistically what has to happen if we're ever to get out of the mess government has dug us into is the United States needs to be broken up into maybe 50 different countries and have a few of them like Estonia who are devoted to having a free society, and let other countries like the country of Obama land have a large welfare state or socialism with pictures of Karl Marx in all the schoolrooms, and then tell them good luck.
The Fed is supposed to be the bank of last resort. The Fed has become the go-to bank. The Fed has become the answer to corporate America's problems. And it has not trickled down to benefit Main Street. And that is where the disparity lies.
How would you grade the Fed, given its performance over the past 100 years?
If I were to grade the Fed on protecting the purchasing power of the dollar, the obvious grade is F, maybe F minus if there is such a thing. And if I were to grade the Fed on smoothing out the business cycle, I would also give it an F. If I were to grade the Fed in helping the government get into aggressive wars that are non-defensive, if I were to grade the Fed on helping the government expand the welfare state beyond what the citizens are willing to pay for the welfare state, I would give it an A+ in that regard.
Well, grading the Fed is a difficult question because you have to grade it in terms of what do you think its job really is. If you think its job is to create prosperity, then you can't really give it a grade because I don't think the Fed can create prosperity. What I think the Fed and a central bank can do is help smooth out business cycles. In other words, make the troughs of the business cycle shorter or more shallow and keep the economy closer on track to its potential GDP, right? And if you think about what prosperity is, prosperity really is shifting out the production possibilities of the country or how much the country can produce, and that's potential GDP. So I don't think monetary policy, insofar as it's designed or implemented, could really shift out potential GDP much at all. But what it can do is keep you close to potential GDP.
I would have to give the Fed an F for failing because its ostensible mission was to prevent business cycles, or at least to dampen the business cycle and to protect the integrity of the dollar. And so on both counts, the Fed has failed miserably. The two worst economic crises in U.S. history, the Great Depression and now what's being called the Great Recession, occurred on the Fed's watch. And the dollar has lost more than 95% of its purchasing power since the creation of the Federal Reserve. So under either metric, the Fed is clearly a failure.
In this age of great inflation, how would I grade the Fed? Well, since we are in an age of great inflation, I would say there were some periods when the Fed maybe did A minus. There were some periods when it C minus or D. Its overall average might be B minus.
What lessons can we learn from the experts we just heard from and the evidence presented through this documentary about the Federal Reserve's performance during the past 100 years? If we evaluate an organization or an institution's performance by what it promises when it was created, the Federal Reserve clearly has failed the American people. The U.S. dollar has lost more than 95% of its purchasing power since the Federal Reserve was created, and the cost of living has skyrocketed since President Nixon severed the last link between the dollar and gold in 1971. Instead of ending or smoothing out the business cycle, the U.S. economy had a major short depression in 1920-21, the Great Depression that lasted more than 10 years in the 1930s, and a series of recessions and depressions since the end of World War II. But for the average person who is not a Fed watcher, understanding how the central bank works is essential to realizing how the Federal Reserve has an enormous impact on our lives. Whether the Federal Reserve can get its act together and fulfill its promise of 1913 to the American people to maintain the purchasing power of the dollar and end the cycle of boom and bust should be the Fed's priority for the next 100 years.